Ladies and gentlemen, welcome to this episode 4 of the Art of Manager Fusion here on EBNet. Today, we are going to talk about the concept of ESG, and not just ESG in isolation, but ultimately how ESG helps you select better asset managers. I want to take it further though. It's not just about selecting asset managers. It's not the only place ESG helps. It also helps you identify risks and what future risks you may be exposed to so that you can take early action in mitigating those risks. But it's not just my opinion. I am joined now by 2 experts in this field. First of all, from Alexforbes Investments, who I know as the head of ESG research, but he is now the head of research. And it's a very important distinction that I would like to talk about. Premal, Ranchod, welcome. Thanks for joining us.
Pleasure.
Premal, just very quickly before I introduce Brett, I've known you for 10 years. You were the guy that was an ESG expert when you joined. We put you in the corner and we told you to only speak when spoken to. You then became the head of ESG, which was, I suppose, somewhat of a accolade to say ESG is important and we need to start thinking about it. Now you're head of research, which makes me feel that ESG is integrated as part of the research, not a supplement to the research. Am I correct in saying that?
Yeah, I'd say also as an evolution of where things have come. Historically, you would have known about ESG as a screened portfolio and so forth over a number of years. Then there was this talk about 10, 15 years ago about how it forms part of Reg 28, starts being integrated. And as you mature on, it's now fully part of the investment process, as you would every other lever that is available to you as an asset manager or investment manager in our case.
Okay, excellent. So we're going to dig into that a little bit because that's really where we want to unpack things and make it practical for our audience to also see it as an integrated function that they can utilize in order to fulfill their fiduciary duty. And then also joining us today, what I call is become a stalwart of the podcasting series with us on EBNet, is Brett Wallington, the head of Paragon Impact. Brett, welcome and thanks for joining again.
Yeah, thanks for having me again, Leon. Appreciate it.
You are a big believer in that if you cannot measure it, you cannot manage it. So Paragon specializes in ultimately determining what the impact of your investments is, what it's doing at the end of the day. How does ESG lead into that? And does that impact lead into ultimately the kind of ESG questions you should be asking?
Yeah, thanks. I think, ESG was, I would say, in its traditional sense, was the starting point of considering these elements in investments, or in terms of understanding this stuff. So, traditionally ESG looked at what are you disclosing? Are you disclosing certain things and what policies you've got in place to potentially mitigate some of those risks? That was a good starting point because what it did is allowed us just to understand, right, who's considering these things as a just to at least understand. The more you're aware of these risks and you're actually measuring them, then perhaps you're doing something about them. But the key thing there is the kind of word perhaps, like, so maybe you are, maybe you aren't. And so the element of impact then comes in from the next step further, is to say, okay, well, what does the implementation of that look like? So you say you might have a carbon reduction strategy. What does that look like? Are you actually reducing it over time, as opposed to just having this so-called carbon strategy in place? Or it might come from other things of labor and employment and all these types of things. So what we start to do is then take that and look like, well, what does implementation actually look like? You've been identified as a significant carbon emitter, and well, look, you're still sitting as one of the biggest, in the 80th percentile emitters in the world. So one would suggest that you're not really doing anything about it and you haven't got any transition plans. And so your transition risk by default then is also then, fairly significant. So really it provides sort of a long-term indicator set to taking ESG to that sort of next measurable level. And I always say, like, I think in the past, we've been looking at this with one eye, kind of only looking at it from the inward piece coming in. We're not looking at it going out the other side and what the implementation actually looks like. So almost looking in the rearview mirror, but not looking out either. So that's sort of, I think, where the two sort of come together.
So one of my first bosses said to me that markets will go up and markets will go down. He guarantees it, but he just can't tell me when and by how much. Right now, to me, ESG is not an exact science, but it allows you to try to identify risks that you're exposed to so that you can understand what that ride might feel like at different stages into the future. And in order to apply the principles behind ESG, because I always refer to ESG as a set of sort of principles or ethics that you can abide by or not, it's a choice. But by measuring the impact of your investments can help you determine the level of risk that you're taking on to then use ESG as a way to then mitigate or ask the right questions. The one on its own doesn't achieve the same thing. Having the two together allows you to make practical or take practical steps in that regard. So a very simple example, and correct me if it's over. In fact, it doesn't matter if it's oversimplified. It's just an example. But if you are heavily exposed to carbon emitters, there's a cost that those carbon emitters are going to feel in the future, which could impact their share price, either for the just transition as they have to readjust their operations and so on, or alternatively, they might start losing business as the market moves away from them. There's a simple example of a risk that you might be exposed to.
Yeah, no, absolutely. I think that's right on. And I think you said the word simpler. I think the more we can make a simple example like that, the better, because I think that's where around ESG and sustainability, impact, these different words that are thrown around, it confuses the market as well. So the simpler we can keep it, the better, so that we can actually take action on these insights that we get. Yeah.
So by the time we release this podcast, the PRI, or Principles for Responsible Investing, along with Crutham, will have released a report on responsible investing that's sponsored by the FSCA. There was a similar report done many years ago, I think around about 2019 or so. And what's interesting to see in the outcome, because we're covering that report from a press perspective, is the outcomes are pretty much the same. The dial hasn't really moved. And in quick sort of summary, it's a case of asset owners, pension funds and so on are I don't know if committed is the right word, but they are very much interested in wanting to adopt responsible investing practices, right? Things like ESG that lead to that, but they don't know how to. So they've got a policy, they've got thoughts, but they don't have actions. And I was presenting some training to a very large pension fund the other weekend, where I put up a picture, which was basically a book that said my responsible investing plan, and it had a lovely cover, but all the pages were empty between the front cover and the back. And I think it's a little bit tongue in cheek, but it's the reality of what we're dealing with, and that's what these reports are ultimately telling us. So when I speak to people about things like ESG, Premal, it's been somewhat of a swear word for the market. Why has that developed in that manner?
Yeah, look, the way I see it is that, people want cake and they want to eat it. So you want to say the good things that you're doing, but you don't want to necessarily give up anything that's up for grabs. We take a topical example of last year. If at the end of December, you didn't hold any resources in your portfolio, basic materials resources, everything pretty much that the South African all share portfolio will have you hold. And you could have said, listen, I wanted to be low carbon. The market delivered 42%. So you're squaring up 2 time horizons here. It's not so much that the concept is not palatable now, or there's a lot of noise that's coming to the market, but rather 2 different time frames. The way I split it is that you're giving asset managers a mandate for 3 to 5 years, and you expect them to deliver according to that mandate, whether it includes an ESG objective or not, but it's a 3 to 5 year period. And in that time frame, there's going to be an event like a commodity price rise because of demand or because of a war. And that can happen, and it can take you out if you're not invested there, which ultimately impacts the long-term returns or the retirement outcomes, at least, of a pension fund investor. But that's a 3 to 5 year period. The pension fund time horizon is now 20 to 40 years. If you took an individual entering a fund at the age of 22 and he exited 62, it's 40 years. So as a pension fund, you've got a much longer time horizon that you're managing assets for. Hopefully, you've got good managers that can transition that capital over time, but it's really a timing thing. And so people are squared behind, did I miss out on that 42% that the market gave last year because I have a strong view on wanting to be low carbon, for example. The way I want to try and pitch the ESG integration exercise is that it's not so much about acronyms or the impact versus the thing. It's traditional investing asks a certain question: can you generate returns and manage risk? The impact investing is saying, will the returns be sustainable all the way into the future? So quite correctly, you pointed out the example of a transition risk if you're not there. I think on the impact side, we are aligned because pension fund vehicle is a longevity vehicle. So if the companies, they can continue with 30, 40% returns now, and then in future we're out there. What we're trying to do is just balance out this equation and say, let's have Brett look at that aspect. Let's have one lens looking at the short to medium term.
But isn't it because for some reason, and maybe it's our fault because we position certain things incorrectly, but we tend to, some people have seen ESG as being an exclusionary exercise, i.e., I'm not going to be allowed to hold any resource stocks. Therefore, if resource does run, I'm going to suffer. And that's not what ESG is. ESG is primarily a set of questions, metrics, ethics, again, to help identify risks and determine which risks you want to mitigate and which risks you want to live with. And in fact, it's not the trustee's duty to go and sit and now determine which stocks to have exposure to or not. And coming to the point of today's conversation, it's actually up to the asset manager to do that on their behalf. It's the trustee's duty to have oversight, to say, are my asset managers using all the tools available, given the current situation in the world, to make the best decisions in that regard. So when you're assessing your asset manager, that's your game, and you look at the people, the process, the philosophy, and you look at their portfolios and what they're investing in, there's probably, I don't know how many factors of things that you would look at to try to determine who's good, who's less good, if I could put it that way. ESG is another filter. It's like bringing a filter in to see and to remove certain things and to hone in on a couple of aspects to see how do they apply themselves in that regard. So if a fund manager isn't considering the just transition when financially modeling the shares that they're going to invest in, surely that's a fault. I mean, how could you not? It's like looking at a company and not taking into account the cost of a new factory they're building just because they haven't built it yet, kind of thing. So isn't that where, if we can try to help the audience a bit, the ESG is there to help create a certain level of rigor and understanding of who's applying themselves in the best way to help you unlock who, in fact, is better than others.
That's right. The way I see it is that if you're selecting fund managers who you think have great ideas in their portfolios, they're able to utilize those ideas to construct something meaningful, and they can actually implement it. Now, where the integration part becomes increasingly more powerful is that in the DD, you might ask a question around, what's your thoughts on ESG? What's your process looking like? How do you consider it? Is it valuations? Is it risk? Is it opportunity set? When you're integrating it into a South African portfolio, it's invariably about the management of risk. So on the point of just transition, you're looking to see whether he's identified that in fact is an idea worth exploring, whether he wants to go underweight a share, whether he wants to go overweight a share, is a value manager, a growth manager. That ultimately needs to be measured according to his process. So if a share is down from 500 to 44 Rand, and we've seen that happen in the case of one of the basic material shares in our market in the time, there was a climate risk that was there in the background burning. There's a governance risks that catalyzed the entire collapse of the share price. Now, if you're a hedge fund manager, you might say that, look, at 44 Rand, for example, this is attractive. But the minute you hold it, if you have that mindset, you're holding it, up to a certain point above your valuation, then you have to bring in the stewardship exercise. You do need to understand whether you completely ignore this long-term risk that you're thinking about and go max overweight according to your process, or you say, listen, there is a unknown variable. I know that there's relative certainty behind a long-term climate event, but I don't know what the quantum is. But then you can't go max overweight. You've got to decide that, listen, there's a portfolio construction or risk management exercise that you've got to deploy in your portfolio. Obviously, if you don't like the share, you're a Fundi manager, you're financials and industrials manager, then resources, you might feel that, look, mining companies are poor cash flow drivers. And you can totally avoid such risks because it's in line with your process. So you'd have measured the just transition. It's not that you don't look at the shares, but you'd be a whole lot more comfortable with your process and say, listen, there's resources there. This isn't my time to shine in the sun. When the market rallies in banks or in industrials, I will certainly be there. And with those banks, they could be financing such companies. They could have big loan books that are also exposed to climate change risk. They could be financing properties companies. Then I expect an element of interrogation and rigor coming through the portfolio there, not just let's hold banks because, say, interest rates are going up.
So I want to interrogate is not the right word. It sounds awful. I want to question you on what you do find when you do research, but I'll come back to that because I want to pose two questions to Brett quickly. So ESG, environmental, social governance, all right? So I often look at the governance and then we talk about King. We now got King 5. It's a set of principles again to help test, are the right controls ultimately in place? Because if the controls are in place, I suppose your risk of something going wrong is less in theory. Right. So do you think that if fund managers historically, and this is a very unfair question, so apologies right up front, but do you think that if fund managers historically applied themselves more in terms of the governance factors within ESG, that the Steinhoffs and the whatever else might have been picked up by a few more?
Yes, that's a very unfair question, Leon. I do agree with that. Obviously it's a difficult question to answer in the sense that I do think that, not completely. I think there's nothing. I mean, it's almost looking at the same thing at the financial crisis of 2008. In America, you just look at the movie The Big Short. You just got to watch that and read the book, and you understand that there were warning signs, and it's very similar. There are these warning signs, and I think that's why measuring the outcomes of these things, and hence why, Steinhoff was sitting on the JSE Responsible Index up until the day things went south. And so again, we're measuring the wrong thing. They were ticking the right boxes of what we're putting in, but no one was kind of looking what was coming out. I think there were some. Premal and I, in fact, have had a discussion where we have talked about that. There were some that kind of saw this and said, something's just not right here with what they've said they're doing and what's really happening, and lots of questions being raised around their financials and all that kind of stuff. So I think, but people get wooed by the story that's being told, and there's going to be a ton of money to be made here, and everyone's just we have very short-term memories, and so we just want to kind of run with it while the sun is shining, and then as soon as that grey cloud comes over, it's finger pointing time and chaos. So I think with a more stringent and honest review and giving more time and more attention to some of the signals that ESG can give, and not just saying, okay, they've ticked that box and they're on that index or whatever it is, that's good enough for me. I'm afraid is not just not going to be enough. You've got to interrogate it a bit more to get a better insight and understanding of where it's going.
But what's so important about that? We refer in our industry continuously. We say all the same things about past performance is not necessarily a guide to future performance. I'm yet to sit in any investment committee where the proposed change to a manager lineup doesn't result in what would have been better past performance. So it's always a performing manager that gets put forward, never a poor performing manager that gets put forward. We're human. Okay, so we see success and then we want that success, and we tend to self-fulfill the success in our analysis thereof. So again, ESG for me is a way of trying to keep oneself honest. I think you use specific words there around the assessment that you do and having honesty in that assessment. So it's not about a case of not believing the good, but it's about saying, well, hang on a second, let's also make sure that all the ingredients are still right within this, because it's about the longer term ultimately that you're trying to drive that performance. So again, that's another practical application from an asset management perspective, that they should be a little bit of a skeptic and not just chase as we might do, and that's what we pay them for, and those are the ones we're trying to find to do the best. And as trustees, same thing. It's not just about chasing the ones that are the best, but are the ones with the best ingredients to continue or to in future produce what we require. But the other question, Alex Hetherington in the market, he's somewhat of an impact and ESG specialist, and he's always spoken to me. I wouldn't say he believes in the exclusionary part of things, but he's often spoken about ESG index products that are available around the world, and that their performance, even where there has been exclusionary, it's actually been pretty good. Right? I don't believe in exclusionary, especially in our market, because our market's too small. But do you know if those types of products globally have in fact produced strong performance relative to something that is unconstrained?
Yeah, so there's been times where they've outperformed. So it's not a something that I think you're going to have ESG indexes or anything like that outperforming traditional ones all the time. That is just not going to happen. Certainly not if you look at what Premal mentioned just now around resources and sort of the market run that you had there. I mean, that's really much more of a, Premal's far more of an expert than I am on that. But there's certainly the ESG ones around that, especially if you had exclusionaries around resources, you would not have outperformed. What we're finding in some of the research that we're doing internally is actually just looking at it again over that long-term time frame that Premal was talking to around the retirement space. And that is what we're finding is that those ESG portfolios or indexes and so on tend to have less extreme cyclicality in their returns over time, because the market doesn't respond as aggressively to whatever might be happening. It could be obviously a big response to carbon, where the EU is pushing certain things around how we trade around carbon, carbon heavy environments, or it could be a war now that what's happening, or it could be other things. And so what you find is that the ESG ones that have that sort of control in place tend to be more exposed to, if you're still going to have resources, you at least have resources companies that are more responsible with the way that they're doing things. And so, for instance, they've actually got a carbon trajectory that's maybe even going down, but they're still a carbon heavy business, but they're actually really doing these things. So when there is a response to these things and you have then essentially a drawdown of these events, what we tend to find across the research that we've looked at is that over the 10 to 15 year period, they tend to not drop as far and tend to recover a bit faster as a result, because they haven't dropped as far. So it's really a balancing act, as Premal said so correctly in the beginning, around the timing. And so there's going to be this up and down of ESG versus non-ESG and traditional, but over time, you'll find that the ESG will give you that more stable return over time. And at the same time, is also at least contributing to a slightly better future than what it would be for that retiree once they finish their 40 years of employment at 62, as Premal said.
So before I move on from you and get back to the asset manager space, we focus a lot on the E, because there's a passion that I think we share in that regard. The governance one, we all know how important that is, particularly in South Africa. You just need to watch the Midlanga Commission to understand the importance of governance. And I think we're getting better, albeit that still a lot of lip service is paid to things like that. So it was like, we've got to get through it, tick the box and move on, rather than, we should apply ourselves as going to help us in that regard. But we don't always talk about the S, and the S within South Africa is critically important because of the past and the development that we need to do in order to normalize things and to create greater equality and so on. We've got so much joblessness within the country and so on. So I'm trying to think of a good example to apply in that respect. when analyzing a company or when seeing how an asset manager analyzes a company. So rather than me give that, I'll think of one while I put you on the spot and ask you to give me an example.
No, perfect. I think that comes very much in terms of what we do and what our what our technology does internally, how we provide the information is one of our strengths, I suppose, is actually on the social side in trying to understand the quality of jobs that are being created, as an example, the contribution towards that is happening around, specifically around South Africa, around our inequality levels. How is that contributing towards that? So when you then look at this holistically, like you said, on the ESG side, South Africa, inherent in the structure of our economy is that we're going to have negative social environmental impacts. Resource heavy, we're sitting there with, obviously a lot of waste generation, water consumption, and carbon heavy, right? So that is inherent, and we're not going to, as you say, going to exclude those stocks, because that would just completely erode everything at the same time. It actually would then erode the economic and social contributions. So what we've got to do is say, right, what are we doing here that's best in class on the environmental side, while still seeing that these guys around those resources are generating the best form of job creation that's responsible, that's fair, that's decent living, and all of that on the other side. So it's about balancing those two angles on both elements. And we use this sort of or we call it our rainbow graph, to kind of illustrate that sort of balancing act that you're finding. And in our economy, it's about, are we generating on the other side some decent social outcomes, particularly around the economic components of our socioeconomic status. And so we look at that. But if your negative environmental is so negative, and you may be exposed to others that really don't care about the waste and water that they're producing, they're rather going to take the fines on for their poor management of slimes dams and all kinds of things. Well, that starts to erode the social side as well, because then that feeds into local, and we've seen that through one particular stock, which I won't obviously mention the name, but it goes into the environment in terms of water that they are now consuming as individuals. And so now you're having this hazardous material going into water that's being consumed. It's driving up illnesses. One particular area had the highest sort of lung disease issues in that area in the whole country, linked directly to the operations that they are having. If it wasn't for that, those lung disease issues wouldn't be there. Now, that is a total erosion of social benefits to the so-called mining activities through that, because you're actually now costing them a lot more on the social side. So it's about balancing that. And as you've said so many times, it's choosing the best in class. And so let's just reward those that are best in class, that are managing those environmental impacts we're talking about well, that at least maximizes those social impacts this country so desperately needs.
EBNet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally, all for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBNet. For more great content, please visit www.ebnet.co.za. But I think, again, it's good for trustees to appreciate that in the context of something like ESG and the fact that it has been seen a bit negatively, is that, do you want exposure to a share that is, or a company that is doing that? Because right now, maybe not everyone knows, but at some point in time, these things come out. And when that happens, that's probably your capital that's at risk in terms of it. So this is, again, that's how it helps you mitigate risks ultimately by applying these principles, this kind of thinking. So Premal, when you are out there and you're researching, I made the comment at the start about you being put in a corner and slowly but surely crawling your way to the center, which is great, because it means now that there's central thinking around these kinds of factors. Within asset managers, it's been very similar. I remember the manager will remain, I won't mention the name, but they're a leading asset manager in South Africa now. They've really come up very nicely. And the CEO phoned me during COVID time when I was sitting at home, and he said, well, I've hired this ESG person. What do you think I should do with them? I thought that was incredibly funny because I mean, like, just the job spec had not been thought through, kind of thing. And every sustainability specialist that I've spoken to within an asset management company, I've always said they've got the toughest job, because you're trying to explain, or you're trying to express certain things to people that are highly logical and analytical, to get them to apply these questions and these principles. And the only way to do that is to ultimately get them to see it as quantitative risk that they are exposed to. So when you're researching fund managers, do you believe that these factors are becoming more commonplace, or do you believe that there's a road still to travel? And I'm going to half answer the question for you, because I'd like you to comment on the fact that Just Share put out a report last year where they surveyed the managers. And while you got a nice comparison of one manager relative to the other, the absolute scores were quite terrific in that regard, simply saying that it's a best of a bad bunch, essentially. So how are you finding it in the manager research space?
Yeah, look, it's incredibly challenging to try and compare a manager to another, and then using his holdings, you want to backward look at whether he's had a good counter or a bad counter with respect to it. When you get into the granular aspect of his process, essentially you're trying to understand if a water shortage can shut down a mine, or if there's governance failure that can destroy shareholder value. All of these are live examples that have happened throughout time. And if the share is big enough in his portfolio, it can erode the alpha that he's achieved from the rest of the shares that he claims to have managed better. So it's less about the box ticking exercise, because I think you can get the box ticking right and still not be able to manage your risk well enough. So I'm kind of moving past the compliance aspect of it, and I'm really trying to gauge whether in fact the analyst has substance in terms of what she's raising. And then when it bubbles up to the top, is it person in a box, or is the portfolio manager really grappling with what has come to his table? Because, as you're well aware, we've got an industry where people that have managed assets for 20 years might say, listen, I know everything about the 80 shares I invest in. And even if you come and tell me today it's ESG, well, historically it was something else, and I've already taken it into account. So, there's a level of arrogance there that you're hoping that you can enlighten him with the data set that's there. The question here is about transparency. You mentioned the points that people don't take too kindly today about it. I think even if you can't measure something accurately enough, the science and the quantum here, or the timing is uncertain, but you're aware that there is genuinely a risk as a manager, well then why not elevate the levels of transparency and data that needs to come out? Then the market mechanism must step in and decide, listen, you are a mine and you got 1,000 deaths. In the 80s, 1,000 deaths was acceptable because you had a big mine, 100,000 workers, and this mine is paying tax. So 1,000 deaths is 0.1%. You say, okay, this is great. That's fine. Whereas today, 10 deaths are 10 deaths too many. So that social aspect you mentioned, you don't necessarily see that it's alleviated inequality necessarily, or the capital you've invested in a pension fund has done that. But you'll find that disclosure in mining companies incredibly. There's a big improvement, at least over the last decade or two. Yes, it comes with regulation and all of that's in there. So that has helped. But if you post something with 100 deaths, I can promise you it's going to be the share price going to be penalized for that. Conversely, if you said, listen, you're a bank, you're also a large employer, but in a bank, I'm not expecting deaths to happen. Short of maybe there's cash in transit, or somebody decides, but that's like 1 in a million year. So the same social risk is not necessarily relevant for a bank. We spoke about inequality there. Your manager needs to be able to understand that if you mechanize this, if you box ticket compliance way, you're going to say certain factor is relevant to a bank and it's relevant to a mining company because of that correlation to your business model. That's what you really are after. Has he identified that, that's irrelevant metric for me to look at here? I should maybe be looking at whether, in fact, there's somebody that is well managed through his career at a bank, as opposed to that. Now, sometimes the social data isn't necessarily available, so it's about elevating through Brett's exercise which metrics make sense for which sector.
But you've eloquently answered the question by giving examples of certain things.
Mhm.
Is the market sufficiently mature at this point in time, and is this yet being taken seriously? I suppose it's a bit of a yes or no if you can try for a yes or no.
I'd say yes, and I'll tell you why.
Okay.
There's no manager in the market today that doesn't have an ESG framework in place. He
Okay.
won't even attempt to go and pitch for a mandate without having said that. I mean, even if you're a startup and you've got 3 guys and a Bloomberg terminal, you're able to get by with a few things. They have service providers that'll tell you how you need to vote if you can't get to those aspects. So the process and the governance aspect, I think, is a non-negotiable, as it is with the market, the FDI. If you don't have governance right, nobody's coming to invest in your country. So that bare basic is already well understood and it's priced. Our recent stewardship report also says the same thing. It's that E and S where you just don't know how much weight to add to it. There, I can say, if you're a small manager, capital is a problem, not skill set.
Okay, so you mentioned your stewardship report there, but before we get to that, because there's something very important with that I want to bring to light, is that you spoke about in analyzing an asset manager, ESG helps you understand them better, how they apply themselves and so on. In the same breath, that asset manager, when analyzing the companies, allows them to understand how well management is ultimately factoring these things into account, because there's a cost associated, a risk, there's a consumer risk that they're facing in terms of those things as well. So there's application at that point. Before we get to your stewardship report and the measurement that you're doing, a lot of trustees will say to me, my job is to ensure members retire comfortably. That means I must produce the right level of returns, and I don't want risks because the complaints file is this big and the compliments file is that big. Okay, so I buy that, but the reality is that you're also having to cater for members that will only retire in 40 years' time, and you need good performing companies then to invest in to produce the returns for them. But also we're investing into an environment where we're having to pay for security ourselves, pay for healthcare ourselves, all the things because of failures that could be avoided if we had better governance and this kind of thinking. So there's an implication of not applying ourselves to it in terms of that member ultimately retiring. And the one that I want to point out there, Brett, maybe just for your comment quickly, and it's a bugbear that I have, which is around online gambling. So what we're seeing is a number of the two-pot withdrawals. I saw a stat the other day, 10% of two-pot withdrawals at one administrator is going to paying off gambling debts. Yet we switch on the TV every Saturday to watch the rugby and whatever, and all of our national heroes are promoting online gambling. Something doesn't seem right there.
Where do I start? That is, yeah. Look, I mean, if I can just talk personally, obviously it is quite disappointing to see, because the reality is, and there's, I mean, I recently actually presented at a trustee meeting, which the online gambling came up as something, and said, but hold on, there's so many people that win and they change their lives over this type of stuff. But going back to the sort of something that Premal did, like 1 in a million case, that's the 1 in a million. And what a lot of people sitting in our, again, going back to the inequality issue, is they're looking for a quick fix to get them out of it, and then they go and make themselves poorer in trying to get out of it through gambling, whilst others get richer. So it's one of those for me that is, yeah, it's a tough one, because I really think it's a big issue, and it's very underplayed because it's become a big market, not only in South Africa. It's the same thing. I mean, I've gone into Kenya. If you go into Nairobi, you've got the same thing also. There's all this online gambling stuff going on there, and it just pushes people more into these kinds of issues. And so now they're drawing out of that exactly to they're borrowing from tomorrow to pay for today. And it's a big problem, and we see it on some of the analysis that we do when you've got that gambling component, that it does come through as something that's got an inherent negative social impact. You cannot avoid that. We can't talk about the one or two that win. That just doesn't. It pales into significance on the other side. Sorry, it's obviously it can be quite an emotional one too.
Yeah, so it's a difficult one in the sense that also you're funding these companies to ultimately prey on the less fortunate, who are then prone to take up that option because they're desperate. So it's I mean, like it's free markets, so I get that, and I'm a big proponent of free markets, but there's also just, I don't know, things do need to come with warnings on, and there needs to be a responsibility ultimately around it. But anyway, let's move on from that. It's just been one that's been sitting on my mind this week.
I want to just maybe close off that conversation. I think sometimes we dwell on what's in the portfolio. So if somebody's not holding a gambling stock in the portfolio or lifestyle, then we say, look, we're a small manager. It's not my dog, not my fight. Whereas this is societal, and it is a drag on the economy for sure. So it is a definite social issue. So the difference here is that, can we as asset owners elevate that particular item that we've pointed out with the regulators and say, look, there's a number of things that it's the government's ambit to regulate this thing here. Sure, they can say that you're paying tax and therefore that's fine. But there are some countries which will go to the extent of saying, to what extent is it a drag on society and their well-being, and the effects on the mind and on debt and all of that there. And then they put in those mechanisms in there so that the necessary companies are penalized at the poll, or they don't come up to the listed market and list in that way. So I think, there is a role for somebody to play, and generally it's the bigger guys that maybe have the balance sheet or the breadth of team to say, I want to go and engage this. I mean, it's come up in a bank, and a bank is a listed entity whereby they thought in their kind of rewards mechanism, they would have such access to a betting agency. And a guy flagged it to me from the inside, and he said, like, how's this even possible that it would turn up? It since hasn't made headway, and it hasn't turned up in their internal model. But that's something that we'll flag immediately to a manager to say, listen, can you maybe ask that probed question?
Yeah, and if you look at Europe, the bigger pension funds have gone as far as actually excluding certain investment types, because I say it's just simply not aligned with their purpose, I suppose you could put it that way. And I think South Africa will develop, but it doesn't stop. ESG is also quite personal, I think. I think every trustee board needs to sit down and talk about what ESG means to them, what's acceptable to them, and what's not ultimately. And that's, I think, part of the consulting job that consultants need to do, is facilitate those discussions, help them fill in their book, essentially from cover to cover, what's acceptable, what's not, how to deal with it, what they would prefer to see, and so on. But when we started off, we spoke about measurement. You guys have, for the first time in the South African market that I've seen, measured the flagship portfolio of Alexforbes Investments, the performer portfolio, which is probably about 10% of the retirement funding market in terms of assets and size. But I actually see it as being a greatest proxy, because it's probably a proxy for all multi-asset type portfolios, and that's nearly 50% of the pot. I wanted to give you a little bit of time to actually demonstrate that, if you don't mind, and you're welcome to share a slide or two or whatever you like, because I think it's a practical way for people to start saying, oh, okay, gee, it would be good to see that, because then I can do something. And that's where we are right now. It's about how do we make all of these things practical and valuable. So I don't know which one of you would like to do that, but I hand over to you. Please feel free.
Yeah, Brett will take this one.
Yeah, I wonder if I can show obviously the report and so on. I think I would like Premal obviously to talk to it on the broader sense, because obviously I'm only going to talk to it from the the Paragon impact and how we look at measuring the impact side. But I'd love for Premal to tie it all together with his much broader understanding of the market, if that's okay, Premal, and Alexforbes' approach. So if you what we've done is now essentially taken this to publicly through the stewardship report the performance of the performer fund or the impacts inherent in it. So in fact, this sort of feeds on nicely from the conversation we had earlier. This is that rainbow that I was mentioning earlier. And this gives you a sense, an idea. Now, you won't be able to see this, and the readers can and obviously go and find it, the viewers. This gives you that sense of balance. And this is what we do is we look at the SDGs, so the UN Sustainable Development Goals, of which there's 17. And that just provides you with a nice set of criteria, or rather, elements of different environmental, social, and governance orientated sort of impacts. So you don't need to know each one of these here, but what you're seeing over here in this particular one is everything to the right-hand side is a net positive, everything to the left is net negative. Now, on the right-hand side, if I go in a bit more, is where you're seeing a lot of these are our social impacts. So there's a lot of positive social contribution through the investments, and that's through the job creation and so on. But it all takes into context various other things. You're balancing the good and bad of the employment that's being created, the financial services that are being embedded through, financial inclusion products that are sitting through the issuers that sit within that portfolio, and so on. Whereas on the left-hand side, we're seeing a lot of those more negative impacts sitting here. So it's really illustrating where those net negative impacts are sitting for the fund and how severe they are. For Alexforbes, what we did here was we ran through a process of looking at what are the most material components, most material issues that you want to be considering in your investment strategy that you believe you have an impact on. And that's where the order comes into play. That's very important. So that's where the core important peripheral. So you're really also placing emphasis on which are the ones that you want to sort of pull the levers the most, or believe we can through how we can engage through stewardship models into the asset managers to ask how things are being done in terms of their engagement models. And so that's where something like this one, which is really SDG 12, which is about resource consumption. So there's water in there, there's waste, there's carbon efficiency. That's where you're seeing our biggest negative in this particular one, because it's obviously linked to the inherent structural, what we've talked about, the South African economy. But very positively, the governance side and economic development and job creation is very positive on the other end. So that's where I talk about that balancing effect. And then as we move down, it's things that are not necessarily not important, but just less prioritized. So even like climate change, which is this green one here, is something that we focus on through SDG 12 anyway, because we have a more efficient, more efficient operations even in that area will naturally start to improve those carbons. And so in that, we then go into the detail, into the next part around, right, what do we need to do? What do we understand about the impacts sitting in those various areas? So, the ones that we're really focusing on around responsible consumption and production sitting within that fund. How can we engage further? We've had it was very interesting giving this presentation at the trustee level, and we start to talk about, what are the questions that as trustees they want to start asking their mandated managers or through the multi-manager. And then the decent work in economic growth, as well as the governance piece sitting within the peace, justice, and strong institutions. So around that in what can be done better, that sits inside that, and where are our strengths that we can keep playing to. And so it really is kind of like a very transparent mirror, not only it's a mirror for Alexforbes to be able to look at themselves and seeing where on their sort of main portfolio things are strong and things are weak, and also where those weaknesses are inherent and we just got to accept them, but what can we do to just mitigate that from getting any worse, or maybe even just improving it by 1% or 2%. And then you're getting down into some other areas around, that's where the numbers are not alone. So by doing this process, we talk about the wacky, so that's, around, and maybe I'll let Premal talk to that. But what this does is that it brings it all together to give you a sense of, right, once we take all these things that sometimes we look at certain indicators in isolation, whether it's gender diversity or if it's around carbon, once we bring that all together and we see how these things link together, we can look at what we need to prioritize. And so it really just gives a very transparent view of what their portfolio is doing and looks like, which was the next step from last year's report.
So maybe in segueing to Premal, if you can just go back to the rainbow again. So I was looking at it and I was thinking, right, if what did you say, it was SDG 12 or 14 or whatever, if that's to do with, call it water or climate change ultimately, that might just simply be a result of the South African economy and the, call it, the level of sophistication of our economy and the types of industry and so on that we have. So as an investor, you might not be able to cut back on that without becoming exclusionary and losing out on potential return. So that wouldn't be responsible. But perhaps you could then target mitigating investments through private markets, as an example, to reduce that and to create more of a balance. It can help lead you to the way you manage your overall portfolio. So is that fair to say?
Yeah, definitely. I think the private markets is definitely a big one of how you can counterbalance what's sitting in the sort of public space. But to sort of counter argument the original thing you said there as well, it is inherent in the South African market. But when we start to take the data, so through our mechanism, we look at, say, on the waste element, and we pull that data in, all of a sudden we found two stocks that are responsible for 48% of the entire portfolio's waste. So then we're going, okay, all right, so these two stocks, why is their waste that much worse than anyone else? Let's go. And that's where you can start to engage. And there might be elements that their waste efficiency, they maybe haven't quite invested to the same level that others have around their sort of practices around maybe more modern mining activities. So there's things that you can then do, again, around engagement to ask those mining activities. And even amongst the two that make up 48%, for instance, you might say, all right, well, one is only like 15% and the other one's made up by the rest. And so then we can look at it and say, right, well, what's the difference? They're both in the, for example, both in gold mining. So, and we do normalize that to revenue. So it's a waste production per revenue, per dollars of revenue. So you are normalizing it to extent. So it also tries to highlight which ones you can then, focus on and say, all right, well, maybe through that and I talked about rewarding and penalizing, and what we're not going to divest completely, but they're both in the gold industry and they're both generating great returns for us at the moment. So we're going to rather move and reweight, the other one a bit more and start an engagement procedure with the other one, or at least to the asset managers anyway, or however it is, just start seeing how they can be improved. So yeah, there are things that can be done than just accepting it inherent in our market.
I said back in 2020, right, that by applying these factors, by looking at stats like this, you can then use it in your due diligence of your asset manager, because I'm willing to bet, and Premal, I wish I could be a fly on the wall. If you could invite me, I want to see when you sit down with the asset manager and point out that those two stocks are driving that situation, whether they are even aware or not. Because it talks a little bit about how close are they to the stocks that they're investing in, what depth of research are they ultimately doing.
That's essentially it. Like we're trying to see whether all data sets have been, like, there's some stuff that's just not disclosed. So if it's not disclosed, he doesn't even know that it does exist. Of course, Brett's tool here is taking into account disclosure that is coming through, but because it's got some kind of forward lens on what he expects of certain companies, you're like, okay, hang on, there's a weakness here. Something's not, it's actually poorly disclosed. It hasn't come up. From my end, I'm trying to gauge whether there's some qualitative factors that haven't even bubbled up. Just on the SDG aspects, the ESG matters everywhere, but the visibility differs by sector. So if you said it's particularly powerful in sectors that have long-term structural risks. One for South Africa, you mentioned the private market stuff. So infrastructure, utilities, the mining is quite evident on that chart. But then agriculture, property, financial services, they have different effects that are going to be evident there. So hopefully with this tool we can gauge what is being left out. Even in the report you find that there's water risks. I mean, everybody knows there's an infrastructure challenge in Gauteng, or there's no water. But to what extent is it financially relevant, or material at least, for everything that's available in the market? Now with this lens, you can ask a more pointed question, and you can say, listen, you say you've got this process in place, you say you covered risks, but were you aware of this? And it's, sometimes you'll see it in a person's face that they don't actually have it, and that's an element of the art and skill that you're hoping to get. Sometimes it's not so much the data point, but it's how the response comes across. You can see someone's clueless, or they're just being flippant about certain risks because the market doesn't price them, therefore he shouldn't care about it. we're operating in a gray area here, but that's
And-
exactly what the skill is.
And trustees, when they assess either a multi-manager or an investment consultant, should understand how these kind of tools are used to be able to analyze the managers better and hold their consultants then ultimately accountable for what is put on the table. And I'm also willing to bet that rainbow wouldn't look as much that way in the favorable side if it wasn't for your private markets program. Correct me if I'm wrong, but I think from the private markets, you ultimately are eking out more impact that affects those SDGs. And it does talk to why are pension funds so underweight private markets at the end of the day, because it's definitely an area where there's better results that could be achieved.
Maybe a little bit correction there. That's part of the listed component within the fund. So Brett's analysis on the impact hasn't in fact taken into account the private market stuff.
Okay.
There's a separate report which is also part of the thing where I've gone and looked at what data points within our private markets program. You know, the one you're very well aware of, it's got 5 sleeves that are going, or 4 sleeves that are going on in there. There are 5 impact areas that we know the assets would. So yeah, if Brett had a way of we could incorporate that, it would lean more positive. In this instance here, the reason it actually looks like it's more positive than negative is because some of the governance aspects do tend to be reported well, and therefore it's going to show up on, say, SDG 16, which says good governance or whatever. So, and we know most of the JSE companies are reasonably well run, but that negative aspect, we've had a big resource rally, so it's no surprise that we're going to be underperforming, at least on the social and on the environmental aspect, but then it should be understood.
But am I right if I've heard you correctly? You're saying the measurement on the private market side is more difficult, less transparency.
Yeah, it's less transparent, and also you don't have all the data points because you've invested with a manager who then has, say, 10 underlying companies in one little sleeve. Maybe it's private equity or something. And in those companies, somebody's got to go out granularly and go and capture data points in the market, which I think is a big cost exercise for a smaller manager, emerging private equity manager. It doesn't have the breadth of that. They often have to go and procure these skills to go and get somebody to say, well, you go and collect XYZ data from the market, or, you know, is there a spreadsheet that says how much are we supplying locally owned businesses, you know, and they're keeping a track. So the difficulty is data there and pricing of the data. The benefit here is that those managers actually see that as an opportunity set. They can use that ESG as an advantage to deliver better if they've got the right opportunity set.
So I hear you, but where I'm going to count on this one is don't then come as a GP or a private market asset manager to me and tell me you impact focus. And unless you're willing to invest heavily in your measurements and applying these factors, don't come claim that you're adding, you know, whatever. That's just marketing. That's greenwashing as far as I'm concerned. There has to be a commitment from them in their operations to fulfill that. They make decent money. And they've got to commit ultimately then to do that. But anyway, that's a whole separate debate, maybe for a whole nother podcast one day, which I'm sure Brett will be on because he's the the preeminent man on all of them. So guys, listen, I think we've been going on great discussion. I really appreciate it. And what you've done there in terms of the measurement I think is fantastic. I mean, the report, as I mentioned, that's coming out is saying that it's the practicalities that are the problem. And this is another great step in terms of making it real for trustees and all asset owners at the end of the day. And just for our audience's attention is that on the 12th of August, we're going to be holding a webinar where we will have the commissioner of the Presidential Climate Commission, along with Brett and along with another ESG expert from Crutham, who wrote the Responsible Investing report. And we're going to be debating, is climate change real? But I think we know the answer to that. But ultimately, what can trustees do specifically in the climate space? What do they need to look out for, and what can they ultimately do to play a role in that respect? So I'm very much looking forward to that discussion on 9 a.m. on the 12th of August. Guys, Brett, Premal, thank you so much for joining us. Thanks for sharing with the audience, and we wish you all the very best and look forward to seeing more stats like that come to the fore.
No, thanks a lot, Leon.
Yep.
Okay.
All the
Thanks,
best,
Leon.
guys.
Thank you
Keep
very
well.
much.
Cheers, Ian.
Cheers, eh?
Bye.
Cheers up.